The big question on every investor's mind is, how safe is my money? Solid investor protection norms play a critical role in getting more people started in the markets and benefiting from the stellar returns they offer. Hello and welcome to a brand new episode of Inside Exchange. And this week, we'll talk about the mechanisms and regulations in place that safeguard your investments in the stock markets. Joining us is a very distinguished panel. We have Prithvi Haldia, founder, chairman and managing director at Prime Database. Also joining us here in the Bombay studios is Mr. R.S. Luna, who is, of course, the managing partner at Dhaval Vasunji Alliance and a former ED at SEBI. Joining us also is Amit Tandon, the founder and managing director at IIAS. Mr. Haldia, if I can begin with you. Risk aversion, of course, is among one of the key reasons why participation in the markets, especially from the retail segment, continues to remain low. I want to ask you to help us understand why the stock market is not this, dangerous gambling den, and there are enough institutional protections in place for investors to actually, make lucrative returns.
Well, I think, there's a risk of equity and there's a risk of fraud. In the stock markets, the risk of fraud has been substantially done away with. If I look back at the last 25 years, ever since SEBI came into being, and look at both the primary and the secondary markets, things don't look the same at all. I mean, whether in terms of the prospectus, disclosures, refund orders, listing time, or in terms of disclosures after listing, and various regulations on insider trading, pledging, I think we have come a long way. So I think processes and policies have ensured that there is no or limited risk of fraud. However, the risk of equity will always remain. Equity can never be an assured return product. And to ensure that investors trade into this market carefully, this is not a market where you just invest and be sure that you'll make good money or tons of money. It's a market where you have to be very careful both about selection of the stock, the right time to enter the stock, to monitor the stock regularly, and then to exit at some point of time, because ultimately the profit has to be in the bank. Because equity, as we know, is a high risk, high reward. I mean, it can also be hugely rewarding, but you can also lose tons of money in equity. I mean, we have scores of cases where prices have fallen by 60, 70, 80%. We have seen IPOs of the 90s where monies have become zero. So equity does not mean that you invest and you'll always make money. You have to be very careful about investing, and you have to continuously monitor your investment or leave it to a professional fund manager.
Right. So the market risks, of course, you have to study. But like Mr. Haldia said, Mr. Luna, that the risk of fraud has in some sense been mitigated over the years. I would actually ask you how a stock exchange has over the years, stepped up its safeguarding mechanisms for investors in terms of the kinds of eligibility norms that they put forward for companies wanting to list, the due diligence and monitoring mechanisms in place. How have these evolved over the past, let's say, 20, 25 years that the markets have really, bloomed in India?
Well, I would say that stock market or the stock exchange, they are actually the first line of regulators. And they try to ensure that how the investors' interests can be protected. And the first and foremost thing which they were required to do, and to a great extent they have achieved now, is that to provide a robust, transparent, fair, screen-based trading platform, and where the investors are assured of trading and getting the assurance that their trades will be settled on T+2 basis. And so there's a proper trading platform, there's a proper settlement system, which all has been introduced by SEBI with the efforts of the stock exchanges and all that. And there are a lot of regulatory measures which have been taken to ensure that the investors are kept informed what is happening in the company. It is not only that once you invest and you do not know that what is happening in the company.
You have a lot of access to information.
Yes.
But Mr. Tandon, if I can get you in, are listed companies, simply by the virtue of the fact that they're open to public scrutiny, a safer investment bet rather than investing in some sort of, chit fund or a scheme or a private investment that offers you higher returns?
Our belief is that coming into through the public markets is far better for most investors, because look, some of what was said with regard to transparency, greater information, etc. is relevant. But when you speak to investors, one of the things which you want is that when you invest, you need to be able to monetize that. So I've invested today, am I able to sell the share which I bought and being able to exit it? And that's one of the big things which the exchange or the listed companies provide you. If you speak to private equity, when they go in and invest in companies, which may be a little bit before a little bit earlier than when they're ready for the market or before their IPO, a great deal of focus on the discussions is what is the liquidity event which will be given to us. So in that sense, there's a huge advantage. You kind of struggle to do some of these things in an unlisted company. So the safeguards are or have been built over the last few years.
Right. And Mr. Haldia, you spoke about how in the 90s, people lost a lot of money in IPOs and so on. But, give me a sense of what happens if listed companies today are seen flouting the norms of the stock exchange repeatedly. Are we in a safer place? Are listed entities today, or are the companies who are coming out with IPOs today much, much, much stronger entities, better regulated?
So I think two things have happened in the last several years. One is that the regulations have become much more stringent, and number two, the market has become much more intelligent. Let me elaborate. For example, there were hardly any entry norms for IPOs in the 90s. Every Tom, Dick and Harry could actually think of an IPO today and float an IPO tomorrow. And we saw almost 3,900 IPOs coming in a 3-year period in the early 90s, and most of them vanished. From then to now, we have a requirement that the company should be in profits of 15 crores or more for the preceding 3 years. That means we are not talking of a novice or somebody who just thinks of a company today and wants an IPO tomorrow. You have to have a track record of minimum 3 years. There is a requirement that qualified institutional buyers should at least buy 50% of the IPO. So there are a lot of stringent, the list is long, but SEBI has ensured over a period of time that the only credible companies are able to enter the market. The second issue is about price. Now, price obviously SEBI does not control, but what we have seen in the last 2-3 years is that the companies have also become much wiser in terms of pricing, and therefore the IPOs, most of them have given reasonable returns. Now, coming to the market intelligence, the markets are now very choosy. The institutional investors, first of all, have to take a call on an IPO because the retail typically follows the institutional investors. And if institutional investors reject an IPO, so the IPO is gone. And that puts a huge, entry norm in a sense for retail investors, or a clue for the retail investors, because he sees the QIB book building and he now knows that there is enough institutional interest in the company, and therefore he is then willing to put his money. We have also seen recently a trend where most of the companies which are entering the market have actually been backed by private equity or venture capital funds, which gives additional comfort to the investors at large that a due validation has been done not only at the time of investment but over a period of time, and therefore the company is really not the fly by night. So the quality of the companies as well as the market
has improved
significantly, and therefore I think we have a much robust market.
Absolutely. Mr. Luna, we spoke about how the stock exchange actually is the first regulator in some sense, but briefly explain to our viewers the role of the capital market regulator, SEBI, or the Securities and Exchange Board of India. How important is the SEBI in this entire, in the scheme of things, and what exactly does it do?
See, as per the preamble of SEBI Act, SEBI is mandated to protect the interest of investors in the securities market and to regulate and develop the securities market. So to achieve these objects, SEBI has taken over a period of time number of measures to regulate as well as promote the market and protect the interest of investors. For that purpose, if you will see that SEBI is regulating the activities of all market intermediaries, which may be brokers, which may be sub-brokers, which may be portfolio managers, FIIs, merchant bankers, or even the mutual funds and so on. And besides that, it also supervises the functioning of the stock exchanges, the depositories. So it plays a vital role in controlling and regulating all these players who are the market participants.
Okay, so we've established that we are a pretty well-governed and regulated market with scope for improvement, of course. But when we come back, we'll tell you how easy it is to be an informed investor these days and where to go if you have a problem with the exchange, the broker, or with the company you've invested in. Stay right there.